Hello, my name is Terence Carter, and I'm the managing partner of Carter's. I'd like to welcome everyone to the first of Carter's 2026 Winter Spring Charity and Not-for-Profit Law webinars. The webinar topic today is legal and accounting issues for endowments, what charities need to know. There's obviously a clear interest in this topic as we have over 1,100 people registered for the webinar today. I'll be presenting on the legal issues involving endowments, and our special guest today, Denzel Pinto, a chartered professional accountant and partner at Doane Grant Thornton, will be presenting on accounting issues involving endowments. Denzel exclusively serves charities and not-for-profit organizations, and by his own estimate has worked with over 100 charities in dealing with accounting issues involving endowments. Denzel and I connected on this topic at a seminar put on by Brad Hoffman and Chris Keeley of Beacon Endowments in the fall. Welcome, Denzel. It's a real pleasure to have you join us on the webinar today.
Great to be here, Terry, and looking forward to presenting this information and hearing the questions from everyone in attendance. Great to be here.
Great. Well, as is the tradition of our law firm, Carter recognizes that its work and the work of his community partners, including the work of Doane Grant Thornton, takes place on traditional Indigenous territories throughout Canada. We acknowledge the 46 treaties and the other land agreements that covers the province of Ontario. We are thankful to work and live in these territories and acknowledge the enduring stewardship of First Nations, Métis, and Inuit people who have cared for these territories since time immemorial, and who continue to contribute to the strength of Ontario and to all communities across the province. A link to the presentation handout materials for today's session was sent to you in the 1-hour reminder emails you should have received. And a video replay will also be available on our YouTube channel within about 24 hours after the webinar concludes. Webinar today will consist of a presentation on legal issues that I will give. Denzel will then present on accounting issues, after which we will have time for about a 20-minute Q&A. If you would like to submit a question at any time, please go to the Q&A icon at the bottom of your Zoom screen and enter it there. Denzel and I will attempt to answer as many of your questions as we can before the end of the webinar, which ends at 1:30 p.m. EST sharp. Please note that these presentations do not constitute legal or accounting advice, and attendees are therefore encouraged to speak to their own legal and accounting professionals to obtain advice as necessary. I will now start my presentation on legal issues involving endowments. Well, this is a great topic. I thoroughly enjoy being able to share with you some of my experiences. I've written on endowments for many years now and have worked with charities together with a number of our lawyers over the years that have held endowments, have created endowments. And so what we're going to share with you today really reflects the input that we've been able to garner over a number of years. I want to thank Selena Natu, our articling student, with the putting together the PowerPoint, as well as Janky Dempster, a partner with our firm, for reviewing content for me. I want to mention that there's a lot of content in the PowerPoints. That's done intentionally so that you will have a good resource tool to take away with you. We obviously can't cover everything on the PowerPoints, but you'll have a written summary of the key points that you would need to have or should have. Now, it wouldn't be a webinar without sharing a few jokes. My staff are extremely good at finding them for me. Why did the university endowment break up with the stock market? It wanted a more stable relationship. This is good because I'm Irish. I got my joint citizenship. Why is Ireland a good investment? Because its capital is Dublin, 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 Dublin. Anyway, you had to be there. So now what we're going to do is move on to our presentation. And the topics that I'm going to be covering are listed there for you. I've chosen a number of different issues that I think are important for charities. I'm going to cover that in the next 35 minutes, and then Denzel will take over for about 30 minutes for his presentation. Everything from what is an endowment, and how do you create an endowment, and what do you consider when you're establishing one, and what do you consider before accepting an endowment gift? What do you do about investing endowment funds, and disbursement of income? What does that mean from an endowment fund? Variation of endowment funds, and then we'll end off talking about managing existing endowment funds. So we'll get started. But I wanted just to point out at the outset, endowments are not for every charity. Some of you may have endowments, some of you may be thinking about endowments. Whether or not it's a good vehicle for your organization, it really depends on a lot of factors that you have to take into account. So this is not meant to be a program to promote endowments, but rather to better understand what you need to do in the event that you're going to be involved in receiving and managing endowment funds. Been a lot of discussion in the charitable sector about endowments over the years. And as a result, the takeaway from this presentation is you need to know the rules. You need to know what you're dealing with when you get involved with endowments, both from a legal and from a accounting standpoint. Denzel will deal with accounting matters. I'm going to be dealing with the legal considerations as we go forward here. Just a reminder again, talk to your legal counsel to get the legal advice that you need. This is not intended to be a legal opinion to you, but rather to help equip the sector with information that hopefully can be of help in what you do with endowments. Well, what is an endowment? There are lots of different opinions and a variety of different ways in which endowments are described within the charitable sector. We've noticed that over many years of working with charities. So what we did is we did a survey of a total of 70 charities, 40 universities and colleges, 20 hospital foundations, 10 community foundations, 10 large charities, to look to see how do they describe endowments in their documentation online. And I read through all of them just to be familiar with what or how the term endowment is used. And what we found is 70% describe the capital of an endowment as being held in perpetuity. 13% describe the capital as being held for a period of time, but not in perpetuity. 7% describe capital as either a long-term fund or in perpetuity. And 10% do not indicate any time frame for holding capital when referencing an endowment. So it's about basically a 70-30% split between in perpetuity and something less than in perpetuity. The confusion also can come up because the reference to an endowment with regards to 10-year gifts. 10-year gifts, some of you may recall, was a way of avoiding the 80% disbursement quota we used to have under the Income Tax Act prior to amendments in 2010. Well, some of that reference is still being used even today. And just to be clear, a 10-year gift is not an endowment. And so we need to be careful not to confuse the two. Another potential confusion that comes up is sometimes a donor advised fund can be referenced as being an endowment. It's simply not correct. Although, as the slide indicates, it is possible to have a donor advised aspect to the disbursement of income from an endowment. But today's not a day to have a discussion about donor advised funds. If we have time during our Q&A, I'll be happy to go into that in a little bit more detail. The reality is that a lot of donors and even charities are not clear in what they mean by the word endowment when they use it in their gift agreements or in their documentation. They haven't really said what their intent is associated with it. And as a result, there is not consistency in the charitable sector about what an endowment means. So that really means it's really important if you're going to be involved in receiving endowments and doing documentation to be clear what you mean. And in that regard, it's helpful to look at what the law has to say about what an endowment is. There is no legislation in Canada that defines an endowment, so we have to look at the common law to see what the courts have said about endowments over the years. The common law is basically case law that's developed. And in that regard, it's helpful to recognize that at law, there are really two types of gifts that a charity can receive, either an unrestricted gift or a restricted gift. Unrestricted gift, great. The charity and the board of directors can use the funds for anything that fits within the charitable purpose of the charity. Lots of flexibility. It's the best type of gift to get. But if it's a restricted gift, what's happened is that the donor has imposed restrictions on how that gift is to be used. It could be conditions, terms of reference. It could be stated restrictions, directions, whatever it is. And so it's important for the charity to be able to comply with those restrictions when they come through. That's to be compared to the board maybe setting aside some monies for a reserve fund for a future day. They can always unrestrict it or unreserve it at a later time. When we're talking about a restricted fund where it's going to be held as an endowment, we're really talking about the charity holding that fund, in this case, an endowment fund, as a specific restricted charitable purpose trust. Could be for a scholarship, it could be for a chair, but it's to be held for a particular purpose. So when we got the charity holding that particular fund in trust, the charity is holding trust funds, but Canada Revenue Agency does not require the charity to have each of those trust funds registered as a separate charity. So it's like a charity within a charity. And the restrictions that you can have with a restricted gift, either it's a use restriction, i.e. use the income for research, or it's a time restriction where the capital is to be held forever in perpetuity or for a long period of time. Or it can be a combination of the two. That's the nature of a restricted gift in place. But it's important to keep in mind that if you're receiving an endowment where the endowment is to be held in perpetuity, that's possible for a charity to do. It's not possible for a nonprofit organization. That's because charities have exemptions from the rule against perpetuity that would otherwise apply. So charities have a particular special role. But once you set up an endowment, there's not the ability to collapse the endowment unless you built something to go within your documentation when you set it up. So what do the courts have to say concerning an endowment? Well, we took a look going back to the UK, British case law, still relevant in Canada. 1893, there was a decision that describes an endowment as being a fruit-bearing source. Interesting terminology. It creates an income source for the particular charitable fund. 1937, the Supreme Court of Canada referred to an endowment in terms of more of a permanent endowment annual incomes to be used in perpetual succession. So certainly suggesting that it's more of a perpetual nature to it. 1992, there was a decision of the BC Supreme Court. Here it talked about creation of a fund intended to generate fixed income revenue. And then when we go over to some of the commentators, the Black Law Dictionary, very famous source of law, 2009 with the 9th edition, talks about it in kind of a number of different ways. It's a gift of money to use for a particular purpose. It can be a permanent pecuniary provision. Money can be held as a permanent fund. All of those definitions have been approved by courts in Canada. The most recent edition in 2024 talked about it being more of a focus on the principle being kept intact indefinitely. So more of a perpetual nature to it. And then south of the border, the U.S. Uniform Prudent Management of Institutional Funds Act again has more of a focus on a permanent nature to the fund, because not all of the fund is going to be dispersed within sort of a quote current basis to it. So there are a number of different definitions that are floating around, but none of them are crystal clear. There are different ways that the courts have made reference to an endowment. So given that fact, what we did is we looked at the basic components that come out of case law. And what we found was that there are sort of four basic elements to it. One is the capital of an endowment is held in trust to generate income for the charitable purpose or the restricted purpose. Secondly, the capital is held as a time-restricted gift, either in perpetuity, forever, a long time, or for a specific period of time. Next, preservation of capital. Generally speaking, there will be a portion of the income earned that will be set aside and retained in order to keep up and protect the capital against inflation. And fourthly, the balance of the income then is to be used either for the general charitable purpose of the charity or for a restricted purpose, such as could be a scholarship, it could be a chair, it could be for any type of programs that the charity would have. So those are what we found to be the basic elements of an endowment at common law. Now enter the accounting profession. The accounting profession does have a definition because accountants need to have certainty. And under their accounting standards, section 4410, and Denzel will speak obviously to this in more detail, they defined an endowment as a type of restricted contribution subject to externally imposed stipulations, specifying the resources contributed be maintained permanently. All right. So as a result, the conclusion with the accounting profession is an endowment is a fund, a contribution that's to be held in perpetuity. All right, so what do? What does the sector do with regards to the approach to be taken? Everyone can have different opinions that this is not black letter law. This is just our approach that we take as lawyers at our firm. So the suggested approach that we take is use the term endowment for funds that are to be held in whole or in part in perpetuity. And use the term long-term fund or an expendable fund for externally restricted funds that are to be expended over a period of time, but not in perpetuity. All right. So that's the suggested approach we say to clients. We wanted to share that with you, but it's not the only approach, and others may have difference of opinions. But remember, you'll have to deal with your accounting professionals. So I always like to work in conjunction with other professionals. That's why we've taken this approach. So for the balance of this presentation, when I refer to endowment, it is to describe a fund where the capital is held in perpetuity. All right. So how do you create an endowment? Endowments are basically created in one of two ways, either by the donor taking the initiative or by the board of directors taking the initiative. If it's going to be a donor taking the initiative, it can either be done in a gift agreement while they're alive, and it's always a good idea for the charity to have a template to work with, or it can be a testamentary provision in a will. And again, if you're encouraging endowments, providing some sample wording that can be used by the lawyers is a good idea so that you can get the exact terms for the endowment that you want to have. The other option is a board-initiated endowment fund. And here, with a board-initiated endowment fund, the board pass a resolution, adopt terms of reference, that they want to set up a particular fund, call it the Millennium Fund. And they'll say, we want people to give to it. When they give to it, here are the terms of reference that are going to apply. The capital will be held in perpetuity. The income is defined as follows, and the income is to be used for whatever. That's very simple. But the terms of reference then become an invitation to donors. So you go on the website, it says, hey, do you want to give the Millennium Fund? You click on, up comes the terms of reference. You agree to the terms of reference, you make your contribution. Now you've got an externally restricted gift that you've made, but the board of directors have determined the parameters for that endowment fund. So it allows the board to have more control with regards to the creation of an endowment. Well, next is, what do you need to consider when you're establishing an endowment program? Or if you're thinking of creating an endowment program, what are some of the issues that you need to think through? Well, first of all, it's a good idea to have terms of reference and figuring out how you're going to manage endowments set out in an endowment policy, or you can include it in a gift acceptance policy if that's where you put it. The types of things that you want to give consideration to is a threshold. What's an appropriate threshold? Do you want to have an endowment for $1,000? I don't think so. Do you want to have an endowment for 100 or 250,000? Probably makes more sense because there's a lot of work associated with maintaining and investing in endowment funds, as we'll talk about. So determine the threshold. And again, there's no magic figure, but we tend to find most of our clients are in the 100 plus range to start. Next, you need to consider the cost of administering each endowment fund. Do you have the ability to be able to do that? And if you're going to allow an endowment fund to be created, is there going to be the ability of donors and family members to be able to contribute to that endowment fund to reach the threshold to create the endowment in place? Then you want to take a look at the types of assets that you have going into your endowment. Monies, that's easy. Gifts in kind, shares, artwork. And so you need to be careful to take a look at your gift acceptance policy, that you have it carefully worked through, keeping in mind that some gifts, like gifts of publicly traded shares, don't have capital gains tax, but other gifts of capital property do, like shares in privately held companies or real property, with certain exceptions. And keep in mind as well, there are receipting obligations. The charity has an obligation to get the right amount, the eligible amount of a receipt, even though it's beyond the scope of our webinar today. I did want to point out that when you're determining the amount, the eligible amount of the receipt, you got to look at whether you have to subtract an advantage, which is a very broad definition, or if it's a gift in kind. Sometimes there can be a deemed fair market value rules that apply to bring the fair market value down. Complicated stuff. Work with your legal and accounting professionals on that. I did include a reference, a link to a CRA, very helpful tax folio. It's a little bit detailed, but if you're interested in the split receipting and deemed fair market value rules, they're available for you as well. Then you need to look at naming rights. A lot of endowments carry naming rights, not all of them, but some of them. Particularly if you're dealing with, a research chair or setting up a scholarship or maybe an endowment to fund a building. Naming rights are big. And so then you have to ask some questions and maybe cross-reference it to your naming policy. How long do the naming rights go on? Forever? Not a good idea. If it's a building, the useful life of the building, or maybe the lesser of the useful life, or maybe a particular period of time, maybe 50 years, 60 years, whatever. So you need to work that through. You also need to take into account what happens if you've got a donor who is problematic, and do you have to sort of retract the right to use the name because of a reputational issue that needs to be worked in as well. Issue comes up about is there an advantage that is to be subtracted from the amount of the receipt. If it's naming rights associated with an individual, not a problem. If it's naming rights over to a business that's going to promote the business and deal with maybe product endorsement, then you probably do have a problem. You'd have to reduce the amount of the receipt. Those are all, again, more complicated issues than just the pure aspect of endowments, but I did want to bring it to your attention. Administration fee, who's going to pay for the cost of maintaining the endowments? And if it's going to need to be paid for of the general fund of the charity, then you may want to have an administration fee that can be taken from the endowment to reimburse the charity for the administration costs. That should be worked into your gift documentation or into a policy. Next, we want to take a look at what do you need to consider before accepting an endowment. Do keep in mind that there's no obligation to accept an endowment, but if you do accept an endowment, you have an obligation. The board of directors are fiduciaries, have an obligation to comply with the terms. If not, you can get into hot water for not complying with restricted terms. Today's not a day to scare anyone, but rather to educate. But it's really important if you're going to accept, you do need to ensure that you can comply with it. Do you have the administrative ability to be able to manage endowments? And do you understand what the terms are associated with the restrictions that are being imposed? All of that needs to be looked at before you agree to accept. Then take a look at the restrictions. Are the restrictions, in fact, legal for a charity? It's not a good idea to set up an endowment supporting a political party for a charity. And then you need to look at whether or not the restrictions fit within the parameters of your charitable purpose of your charity. You can't do something that you don't have the corporate authority to do. Then you need to look to see whether or not the restrictions are possible and practical, because if not, you may not want to receive the gift. And as well, if you're being asked by the donor to do something that you don't want to do, run a program that you don't want to run, even though it may be possible or practical, you don't have to accept it. There's no obligation to do so. So you're in control as the charity as you put these together. If you do accept a endowment as a restricted gift, but then you find out maybe some of the use restrictions can't be complied with, then you can look at varying it. If you don't have the ability yourself to do it, you can seek assistance from the court through the court's praise scheme-making power as near as possible. But hopefully you want to build in some ability to vary the terms if something like that came up. Once you receive the gift, obligation to make sure you comply with the gift, and you got to make sure that new board members coming on are aware of the obligations with regards to compliance with endowments. It's very important to do that. So then we go over to investing endowment funds, and this could be a whole separate topic itself. I'm just going to give some highlights here. You need to know what investment powers apply. So you take a look at your corporate documents for your charity. And if it's not clear from articles of incorporation, then the Trustee Act in your particular province will likely apply. You should have a general investment policy that sets out the parameters for doing investments. not only of endowments, but just of any funds that need to be invested. Here I've given you sort of a highlight of some of the key issues, beneficial, frankly, from the Trustee Act. It gives you a lot of flexibility in investing as a prudent investor standard applies. Keep in mind, and again, it's not a topic for today, but if you're thinking of investing in impact investing or social investments in Ontario, there is legislation that permits social investment, basically dual purpose investments, achieving a charitable purpose together with a return. But you can't do that with endowments unless the board of directors are satisfied that there will be no encroachment of endowment, of the capital of the endowment, or the gift agreement permits it to be done. And keep in mind as well, if you're thinking about impact investing, you cannot delegate investment decision-making involving social investments in Ontario. Good news about the Trustee Act, if you comply with it, you'll get statutory protection, which can be very beneficial. Also keep in mind that if you are investing through a delegated investment manager, the funds of the endowment, at common law, you can't delegate. In Ontario and most other provinces, you can delegate, but you have to comply with the requirements of the Trustee Act. And I set out some of those requirements here. An agency agreement, these reflect your general investment policy. And keep in mind that delegated investment managers have statutory requirements of the standard that they're supposed to invest. So therefore, sometimes we've seen in investment documentation from financial institutions, they will ask the charity to indemnify the financial institution. That's not appropriate because the obligation is upon the delegated investment manager. So again, do take a look at your documentation with your lawyer to make sure that it's consistent with what your fiduciary obligations are under the applicable Trustee Act. Can you take a number of endowment funds and commingle them together for investment purposes? The answer is at common law, you couldn't, but in Ontario, you can. Regulations were passed back in 2001 to permit commingling of restricted funds, but there's certain things that you have to go through to ensure that you comply. And keep in mind that you cannot commingle restricted, like endowment funds, with general funds. You cannot commingle the two of them together. Next, I want to talk briefly about disbursement of income. And I think the key takeaway is if you're doing endowment agreements, you need to be able to define income as being calculated on a total return investment approach, which allows you then to include as income to be dispersed, not only traditional income, which is interest, dividends, rent, and royalties, but also realized capital gains. If you have not defined income in that broader context of a total return investment approach, you may have a problem if you're spending income, including realized capital gains. It's a real issue that we see frequently when we do reviews for clients. So keep that in mind that you want a broad definition for income to go into your documentation. If it turns out that you have a problem, that you got a classic definition of income, very narrow, and you want to get it broader, then if you don't have the ability to vary the terms, you can then seek assistance from the courts. In Ontario, you can get a consent order under the Charities Accounting Act. And also keep in mind that the income that's produced should be used to help preserve capital against inflation and ensure that you're meeting your disbursement quota, 3.5% of the first million and 5% on the balance that's not used directly in charitable activities or administration. Then I want to talk a little bit about variation of endowment funds. Here, it's important that when you draft your endowment documentation, that you include in it the ability of the charity to be able to vary the terms. Donors cannot, on their own, vary the terms. Why? Because they've given the gift over to the charity. But the charity needs to have that ability to vary terms, and you need to build that into the gift agreement, not only with regards to the use of property, use of income, but also sometimes to be able, in a limited situation, to encroach on capital for something like an extraordinary circumstances, such as sort of an existential crisis that we dealt with back during the pandemic, or in meeting your disbursement quota requirement. So careful drafting in that regard is important to do. Final topic or issue that I want to address is the importance of taking an inventory. Everything we talked about is sort of perspective of how to get an endowment program in place. This is dealing with charities. It could be foundations, universities, hospitals that have got a large number of endowments. You need to take an inventory of them to find out what you've got, what are the obligations that you have, and what do you need to do if there's not been compliance in the past. In order to do that, you need to go back to the original documentation and take a look at it. It could be the terms of an endowment agreement, terms of wills. It could be notes to financial statements, sometimes can be helpful in seeing the intent that was associated with it, board resolutions. So go back to your source documents to find out what was intended when that endowment was created. So once you've done that, then you will have a good idea whether or not there are deficiencies, non-compliance. Non-compliance is not fun, but it does happen. What we often do is we look to see if there's non-compliance. Is it really non-compliance? Maybe it's just wording that's not binding restricted, but rather what we call precatory, which means it's suggestive language, but not intended to be binding. Sometimes that can be an easy fix of something that's considered to be in non-compliance. So when you go through and you take a look at the non-compliance, now you've got to then determine what to do. And sometimes in that regard, you have to speak to your legal counsel to get advice what to do. You need to talk to the board of directors. You need to consider possibly getting assistance from the court. In Ontario, it's a lot easier because of Section 13 of the Charities Accounting Act. But you can't just leave it. If you see that there's a compliance problem, you need to think through solutions so you're not leaving a problem for future generations of board members. And in that regard, it is important to look at the possibility of transfer of endowment funds. Sometimes charities may want to offload the responsibilities, maybe over to a parallel foundation or maybe a community foundation. Can you do that? Well, in order to do that, first of all, you got to know the endowment funds that are being moved to ensure that there's compliance and making sure that the subsequent charity will take responsibility on a go-forward basis. Take a look to see whether you've got the authority in your gift agreement or in your policies to do so. Otherwise, you can take a look at the Trustee Act of your particular province to see what is permitted in relation to transfer of endowment funds. Assuming that you have the authority, you can either do it here in Ontario through a deed of appointment under Section 3 of the Trustee Act. Other provinces, different sections that would apply. Sometimes you have to get a court order because of some of the complexities that are involved. Just to point out that there are issues, again, complicated, but issues when you're transferring funds over to a non-arm's length charity. There are rules about disbursement of the funds within the same year or the following year. If you've got a transfer going to a non-arm's length charity, then you may want to make it a designated gift. Again, I've given you a couple of points there that might help you, but you have to look at things holistically. You cannot work in sort of a silo in a vacuum. You must see the other rules that apply. All right, so the key takeaways is really important, first of all, to choose the words carefully when you're putting together gift agreements for endowments. We suggest using the word endowment where the capital is to be held in perpetuity, coincides with the accounting profession. Suggest using long-term fund or expendable fund when the capital is not to be held in perpetuity, but expended over a period of time. Defined income by using a total return investment approach. Take an inventory of your endowments and externally restricted gifts to ensure compliance and work with your board of directors and legal counsel on that. And if non-compliance is found, then it's not the end of the world. Better to know that there's an issue and work towards a solution than ignoring it. That's the key takeaway. This is not meant to be in any way sort of a fearful approach, but rather an empowering approach in order to better manage the endowment funds that you have. For those of you that like to read more, there are some resources that we have available for you. And as well, the very famous disclaimer clause, it's not legal advice, so you can't sue me. So now we're going to go over to Denzel. Thanks very much for everyone being patient with it. And Denzel is going to cover the accounting issues associated with endowments. And we're really looking forward to your presentation. Thanks very much.
Absolutely. Well, thank you so much, Terry, for inviting me to be here today. As Terry mentioned, I'm going to be talking about the accounting issues with regards to endowment. Now, you'll see there's a lot of crossover in terms of terms and such. A lot of what Terry said in terms of the implications of endowments are very similar in the accounting context. There are a few differences here and there, just like Terry has mentioned, but we're going to go through and kind of talk through the accounting issues we generally see for endowments. So the first question might be asking, well, why are we talking about the accounting issues for endowments? Well, as we've already alluded, there are misconceptions of what endowments is. And I don't know about all of everyone on this call. I've even seen endowments used very liberally, used to just mean a donation or gift in general, not something even restricted. The thing is, under ASMPO, it is very specific what an endowment is. And so what I'm here to do is really to identify what an endowment is, what endowment contribution is, and if it's not that, also give you context as to what it potentially would be as a result. The other reason we're talking about this is we're in an interesting time of life where obtaining gifts is becoming more and more difficult. We're seeing, because of the economic situation, people, organizations trying to be stricter with giving expenses and giving donations. On top of that, we have a general shift in ideology when it comes to gifting, where, for better or for worse, loyalty has to be continually earned. Gone are the days where donors would just give to organizations on a regular basis for multiple years. It has to be continually earned. The threshold over which someone would change their mind as to donating to an organization is much lower. And unfortunately, one of the things that could be an implication is it relates to financial reporting. If in discussing the donation with an organization, or a donor, the financial reporting doesn't match the expectations of what the donor has indicated, that can create a misalignment. That could create tension, could create a situation where they reduce or move donations. And it also, in addition to that, we know the people talking to donors tend to be senior management, tend to be fundraisers, not necessarily those involved with finance. So it's important for everyone to know what the accounting implications are of certain terms, of certain information, and to be able to communicate that well to donors to avoid, this particular area that could create an issue with the donor. Remember, at the end of the day, a charity's fundraising goal is to receive gifts, use them appropriately, and honor donors' wishes. And that last piece is very important. At the end of the day, if you're able to honor donors' wishes, not only does that create potentially, well, likely a recurring donation, but could also lead to that word of mouth that works so well to get additional funds to charities. And again, we talk about obstacles to that goal. Words matter. We're going to talk about terms and how it's important for those to be thought through as to what that context is from financial reporting, the accounting treatment itself, but also unclear financial strategy. And this links to Terry's comments in terms of the idea that endowments may not be the actual approach, the best approach for an organization at a point in time. We've seen many organizations, particularly colleges and universities, we've seen where, you build a ton of endowments, but that's been built over years, but then the operations don't have enough funds to continue going. It's having that balance between those in that strategy in order to really achieve the goals of the organization. So today in my presentation, I'm really going to talk about two key things. Number one, we're going to define what contributions are. We're going to say, and all the definitions here are coming from ASMPO, the accounting standards. Then we're going to talk about recognizing contributions in revenue under ASMPO. We're defining it because while the endowment is a particular definition, if something falls out of that, we want to provide you with information as to what type of donation that might be under ASMPO. And then we're talking about recognition because it's not that straightforward. And that's a spoiler alert. There's two methods that's completely available to use when accounting for revenue under ASMPO. You could have exactly the same organization, the same results with another organization, and you could have different financial results in your financial statements simply because you use the different methods. So we're going to talk through how recognizing contribution shows in these different methods and the things to consider when it comes to which method works best for you. So let's jump right in. We're going to start with what is a contribution. So again, this is section 4410, as Terry had mentioned, the definition straight from there, a non-reciprocal transfer to a not-for-profit organization of cash or other assets, or a non-reciprocal settlement or cancellation with liabilities. So non-reciprocal, it's one way. There's nothing coming back the other way. If there's something you're getting in return, then either this may not be a donation, or at least a portion of it may not be a donation. It's also to a not-for-profit organization. Again, this is under the ASMPO standard, which is particularly for not-for-profit organizations, which includes charities. And then the people always think about assets being given as part of donation, but also think about the settlement or cancellation of liabilities. The most common one we've seen is loan forgiveness. For those of you who perhaps have got the SEBA loan during COVID, that loan forgiveness was an example of technically a contribution in a different limelight. So let's go through the types of contributions under ASMPO. So there's three types of contributions. It's a little different to what Terry's mentioned in terms of two, but the same ideology. There's restricted, endowment, and unrestricted. All contributions, all donations fall into one of those buckets under ASMPO. Let's go through each one. First, a restricted contribution. Well, a restricted contribution is an externally imposed stipulation that specifies the purpose and or time period for the donation to be used. So specify it is external. So it's someone external to the organization, donor, government, whoever, to identify that there's a stipulation for purpose. So again, could be for, could a multitude of projects for a certain project, or for a time period, for a few years down the line, you're allowed to use it. Now, it could be imposed explicitly or implicitly. Explicitly is what we most think about. You give a donation, you say, this is for Project C. Implicitly, we don't always think about. And the best way to describe this, it's the context of the circumstance that gets the donation. The easiest example I can think of to provide that context would be if you're part of an organization, does a number of different projects, but you're having a fundraising event for Project C. Well, in that event, people may be giving donations, but if they're giving it to that fundraising event for Project C, it is reasonable to think that it's implicitly restricting it for that particular project. So again, think about that in terms of the context, implicitly binding. What are you saying to get the donations? What are you communicating to donors? And is it reasonable that that donor is expecting that to be used for that purpose? Now, for restricted contributions, it may need to be returned. The most common type we see this in is government funding. And yes, government funding is considered a contribution under this standard. So government funding, a lot of times there is a certain time period you're supposed to use it. And after that point in time, if you have excess funds, it's to be returned. You also see that in other donation agreements. It's just not as common as the government. Now, some of you might be thinking, oh, like I've heard this thing called an internally restricted contribution. Well, and this derives from the idea that there are internally restricted funds. Now, internally restricted funds or net assets is a situation where the board has determined or approved to move an amount from its unrestricted funds to another fund separate to that internally restricted fund for a particular purpose that the board has determined. So a lot of times we see operating reserves, strategic reserves, something along those lines. And sometimes what we see is, if there's a contribution coming in and we want to put it in that fund, it should be an internally restricted contribution. Well, actually, the idea technically of internally restricted contribution, that technically doesn't exist. And the reason being is that for something to be internally restricted, it has to be received by the organization. The board can't internally restrict something it does not have control over at that point. So the actual appropriate treatment is for it to flow through your unrestricted fund and then be transferred over to that internally restricted fund. So again, that's just technically there is no such thing as an internally restricted contribution in the handbook. If we flip over to endowment contributions, again, the reason we're here today, again, this is a type of restricted contributions, but it's particularly separated because it's externally imposed, but it's specifying the resources to be maintained permanently. Perpetuity is also thrown out in terms of it, but that is the ASMPO handbook definition. It's permanency. If it doesn't have permanency, then it's not an endowment. So you want to be careful with the use of the term endowment. If you're using the term endowment and there's no context around it, you want to be able to you probably like to talk to your legal counsel about it to figure out how exactly it should be communicated, because it could be default into permanency or something along those lines, even if the intention was not that way, if it was written that way. Now, Terry mentioned some different types of contributions, and we've seen organizations say, well, we have an endowment contribution, we're going to hold it for 10 years and then use it. Well, in reality, if you're going to be able to use it in the future, then that's not an endowment, because an endowment is permanency. It's perpetuity. It's just a type of restricted contribution, but it's not an endowment. And again, we also hear the term of internally restricted endowments. Can you put money aside, board-initiated money aside for permanency in terms of it? And you absolutely can. There is nothing wrong with it. The only thing that it's not typically clear in the handbook whether the term endowment should be used, because as said here, the endowment indicates external restrictions. It could create confusion over it, but again, it's completely allowable to do that. A lot of times, at the end of the day, remember, if you have an internally restricted endowment, it's effectively just another form of an internally restricted fund, which the board can choose to change its mind and move it back and forth as it sees fit. Now, the last type of donation or contribution is an unrestricted contribution. It's neither restricted nor an endowment. So anything that doesn't fall into the endowment or the restricted category is an unrestricted contribution. Now, one thing you do want to think about when it comes to restricted contribution is the restriction actually restrictive? And by that, I mean, we've seen certain situations where someone may give a donation, but the restriction is so broad or vague that it could cover the entirety of the organization. So for example, I've seen situations where it's restricted for the mission of the organization or restricted for all the operations of the organization. In that context, even though there is a restriction associated with it, if that restriction is not restrictive to you, then that actually would technically be an unrestricted contribution. And again, that's very different to having a restriction that can be used. This is a restriction that can be used for anything that your organization does because of the way it's termed. So again, something to think about when you receive those contributions. So with that, that's defining contribution. Now let's talk about recognizing contributions and revenue under ASMPO. So as I mentioned, there are two methods, the deferral method and the restricted fund method. How we're going to walk through this is we're going to walk through the different types of contributions and indicate what method is used and how it's going to be recognized. So first, we have restricted contributions. So under the deferral method, you would record it as a deferred contribution and then recognize it in revenue when that restriction is fulfilled. So whether that expense has been incurred or the time period has elapsed that the restriction is on, you would recognize it in revenue at that point in time. Under the restricted fund method, it'd be immediately recognized in the corresponding restricted fund. Now, in this context, we are assuming that this restriction that was received has a restricted fund for it. So again, if you give a donation for Project C, that Project C has a restricted fund associated with it, and thus it's recognized immediately in restricted fund. We'll talk in a minute about what happens if there isn't. Now, if it's an endowment contribution, you actually never recognize it in your statement of operations under the deferral method. It's never recognized as revenue. It goes directly into your net assets or fund balances as an increase. Under the restricted fund method, it immediately goes into an endowment fund, and that's part of your statement of operations. And then unrestricted, in both cases, it's recognized immediately. Just for the restricted fund methods, it's immediately in the general fund. Now you'll see a little star there that indicates, well, it must have at least one restricted fund. Now, you might be thinking, well, why is that? Well, it really comes down to the treatment if you don't have a restricted fund for the purpose that you're given a contribution for. So what happens if you have the restricted fund method and receive a restricted contribution, there's no corresponding restricted fund? Again, going back to the example, someone has given you a restricted contribution for Project C. There's no restricted fund for Project C. How do you treat it? Well, there's two options. First of all, you could just use the deferral method in the restricted fund accounting. So you basically would defer it and recognize in revenue in the general fund. This is all in the general fund. And you recognize the revenue when the restrictions are fulfilled. The other option is to create a restricted fund for that contribution. And then you would follow the restricted fund method and recognize it immediately. Obviously, when you do create a restricted fund, you have to reflect it retrospectively as if it always been there. But if you've never had a donation in that fund or those donations have long ago been fulfilled, it's not going to create an issue for you. So now you might be able to see, well, what happens if you don't have a restricted fund and you use the restricted fund method, then the second option there is immediately eliminated. You don't have a restricted fund. So you default into using the deferral method. So effectively, if you indicate you're using the restricted fund method, but you don't have a restricted fund, you're actually using the deferral method. So that's why that note was there to say that's when there is a restricted fund. That's the restricted fund method. Now, I want to talk just briefly on capital assets because it's a little different there. If you receive contributions for capital assets, if they're depreciable, you recognize it under deferral method, you put it as a deferred capital contributions and then recognize it in revenue on the same basis of the amortization of the related asset. Restricted fund method, immediately in the capital asset fund. If it's non-depreciable, like land, under deferral, direct increase in net assets, restricted fund, immediately in the restricted fund for capital assets. So again, something to consider when it comes to capital assets. I do know a number of organizations, because that deferred capital contribution is a liability and might be there for years and years, you might consider creating a restricted fund, or even if you're using deferral, move to the restricted fund method to avoid having that liability. That's a choice up to you in terms of it, and your accounting provider can work with you through that. Now, you might be thinking, okay, for endowment contributions, when is investment income earned recognized in revenue? And in this context, we're talking about investment income, as Terry had mentioned. So interest and dividends being the main one, but also rent and royalties fall under this category. And it depends. But it generally follows the same notion of the contributions that and how they were recognized. So if you receive restricted contributions, if you have a revenue that is restricted, earned on the endowment, You defer and recognize under the deferral method immediately in the restricted fund under the restricted fund method. If it's to be added to the principal of endowment, it's a direct increase or decrease in net assets. Under the restricted fund methods, it is immediately in the endowment fund. If it's unrestricted, then it's immediately restricted immediately in the general fund. So again, follows that note. But again, just to be clear, that is the investment income. And again, that is your interest, dividends primarily, but also rent and royalties fall into that category. Just to stress again, one of the comments that Terry has indicated, realized and unrealized gains can get complicated because of the legal context that is capital income. Unless your agreement specifically indicates something to that degree of what they're going to be used, or as Terry has indicated, do the full return method of calculating of your investments to determine kind of what gets invested in what. You really need to ensure that's context. Unfortunately, I've seen a number of organizations who, have had endowments for 30 plus years. 30 years ago, the idea of having huge amounts of realized and unrealized income was not present. It was much more interest and dividends. So the idea of putting any sort of clause about that was not present. And they're in situations where anything that they earn that is realized or unrealized gets added to their endowments. If you are in that situation, which it's entirely possible you might be, you might want to consider what can you do with your investment strategy in order to ensure that you are maximizing what you can get in terms of interest and dividends for those particular endowments, and put other items like your restricted or unrestricted contributions into more of those equities, pooled funds, things of that nature. One other thing I do want to stress is that, as Terry mentioned, when you do receive a restriction, when you accept that restriction, accept that endowment, you're accepting those terms at that point in time. You can't go back to the donor and change those terms unless there are very specific clauses, as Terry mentioned, in the actual agreement. And there's certain limitations to what you can actually put in there. So that's something to talk to your legal counsel when you're forming the agreement. But you can't really go back in terms of that. Changing after that fact takes a little bit of time. Again, as Terry mentioned, you can go through the court system. That obviously takes time and effort to do, but it is an option. The more you can be very clear in the terms at the very start and be comfortable, not only at this point in time, but also in the future, the better you're going to be. And again, Terry mentioned this, but you can absolutely say no to a donation if it doesn't meet your terms. It doesn't make sense to take something that may just sit aside for years because it can't be used for its purpose, for the intended purpose. Now, the good news is I'm seeing a lot of more situations where donors are willing to have those communications with organizations to figure out a term that can work for the organization and also the donor. At the end of the day, the donor is looking to help the impact of the organization. So a few takeaways from our discussion. Accounting defines endowment. There is a definition for it under accounting standards. But it is important to understand if the donation is truly an endowment. One of the first things I do when I speak to organizations or individuals when they're talking about endowments is step back and ask them, okay, what exactly is this contribution that you're talking about? Like, what are the terms of it? To determine if it's truly an endowment or if it's the term endowment being used a bit liberally from an accounting perspective. And then the accounting really flows from that determination. And if you're able to truly understand what the nature of it is, you can get an idea of what the accounting is and hopefully have those communications with those that are donating, the donors, the organization, the individuals, so that there is clear alignment and transparency as to what's going to happen with regards to financial reporting as a result of this endowment. And that's just taking one more thing off the chessboard that could create an issue in the long run with the donor relationship. So I really appreciate your time today. Just a few disclaimer, just like Terry had. And of course, if anything does come up that you do want to speak to me about, I'm always available, always willing to chat. Right now, I'm going to pass it back to Terry, who's going to start the Q&A portion of the session.
Oh, that's great. Thank you very much, Denzel. That was very succinct and covered a lot of territory. I learned a lot, so thank you for that. I'm sure the others on the webinar learned a lot as well. So we've been having a lot of questions come in. We have about 20, 25 minutes. So we'll try to get through as many of them as we can. And what we'll do is we'll look at each question from a legal context and then from an accounting context, or vice versa, accounting and then legal. So Denzel, I'm gonna invite you to participate in all of these questions. The first one says, what is the difference between an endowment fund and a donor advised fund? Um, Maybe what I can do is start this one off, Denzel, and then maybe you could add in. Um, First of all, there has been a very good resource tool made available by the Canadian Association of Gift Planners, CAGP. I'm a member of it, and Denzel is, I think you're the treasurer for the CAGP.
That's correct, yes.
Put a little plug in. Myself and Jackie Dempsey were involved in a committee that helped to put together a very useful tool to explain what donor advised funds are and what the obligations and the issues are. So just really would encourage you, if you want to get more information, to take a look at the CAGP website for that. In essence, when you have a donor advised fund, it is a gift over to a charity, and the donor has the ability to be consulted by the charity concerning distribution of either income or capital. That donor advised aspect, however, is not binding. It's not that the donor gets to tell the charity what to do, but rather it's a opportunity for the charity to seek out the advice, suggestions, the input from the donor. Sometimes it is perception is that a donor advised fund is sort of like the monies of the donor being held by the DAF, the donor advised fund charity. That's not correct. So the basic idea is you give a gift and the donor continues to have input with regards to how the funds are dispersed. You can take that donor advised aspect and you can layer that on top of an endowment. But a donor advised fund is not an endowment, because an endowment is something different. It's a gift with the restriction that the capital is to be held, according to our definition, in perpetuity, with the income to be used for a restricted purpose. The application of the income could have a donor advised aspect to it to seek the advice from the donor. But donor advised funds, endowments are two separate things, although you can combine the two of them together. Denzel, do you want to add anything on that?
Yeah, I mean, I think you indicated it well. I mean, at the end of the day, the donor advised funds are meant to be almost like just a manner for the donor to be involved in the process of kind of determining what's going on with these funds. It's not, as you said, binding, but at the end of the day, it's not an endowment. There could be elements of it within it, just like there could be elements of restricted contributions within it. It really depends on how it's structured. I guess theoretically, if you wanted to create a donor advised fund that was simply an endowment where you have advising over investment income, theoretically you could, but I actually haven't really seen it. Most of the situations you see donor advised funds, it's meant for the money to be used in at some point, whether it be now or in the future. So from that standpoint, I really haven't seen too much that could be similar to endowment, but at the same point, I guess it is theoretically possible for it to be structured in that way.
Okay, thank you for that, Denzel. Next question, this one's over to you to take first cut at. Do notes to financial statements constitute conclusive evidence for the existence of an endowment? Maybe you want to explain what notes are and what sort of information would go into a note, and then tell us whether it constitutes conclusive evidence or not for the existence of an endowment.
Absolutely. So the notes of the financial statements are effectively if you look at your audited financial statements, they're the notes, they're they're the paragraphs that basically describe the policies and the information regarding the financial statements that are presented and under ASMPO. And typically, when it comes to you having endowments, there are typically some notes that discuss the terms of the endowment, so that a user looking at the financial statements could understand what are the terms of the use of the endowment. In kind of a minimal perspective, it would indicate, how much is to be used, like the income's to be used, but for what purpose? Is it restricted? Is it unrestricted? Is it adding back to the endowment? At minimal, would talk about the policies around the accounting for that endowment. Now, in terms of your question, the fact that it's in the notes, would it be definitive evidence? I would say kind of it depends. That's a classic auditor answer. So when you look at the notes of the financial statements, yes, they've been audited and they've been looked at from the context of, is it reasonable from that perspective? Um, and so for me, I would use that as a guide that there is an endowment and ask some particular questions to get additional information in terms of it. Um, Again, sometimes, as I said, that term endowments can be thrown around a lot, which is part of the reason I say it depends. But it will give you a good starting point to be able to go and ask questions from. Remember, audited financial statements are done at a basis of materiality, meaning that we don't look at 100% of everything that's going on. So depending on how big or how significant some of the contributions or movements are in the endowment, it may not be looked at the level of detail that you would be wanting in the context that you're trying to definitively prove it. So I would always use it as a good starting point to focus your direction or your next questions.
Yeah, that's a good answer. Certainly from a legal standpoint, we're always interested to see what the accountant has to say, but it's not definitive. It's sort of a secondary observation. We got to go back to the original documentation, as I mentioned in our presentation. That determines the intent of the donor, and it's really important to maintain your documentation in that regard. Next is a question. What are the potential legal and accounting implications of treating endowments incorrectly? So maybe I'll start with you on that one, Denzel. What are the potential accounting and legal implications of treating endowments incorrectly?
I mean, obviously, from the standpoint, if you're a charity and you're doing things incorrectly, there's always the potential risk to things like charitable status and things of that nature. The one that impacts, I think, the most is reputational status. If you're doing something, again, that you're not following the donor's intentions, or you're not following the law in terms of that, and that gets around, that can have a huge implication overall in terms of it. There are, I think you can talk more about the more significant ones, but again, at the end of the day, it's just you want to make sure you're doing your best to abide by everything. And again, we've seen situations where, there has been, the Office of the Public Guardian has come to charities and questioned things and gone to the records and things of that nature. So, and a lot of that is driven by your stakeholders, those of you who are looking at your statements or involved with you raising something, as opposed to necessarily kind of an annual review or something like that. I'll pass it back to you, Terry, to add anything.
No, good answer. Often the question comes up is, well, there may be a problem. Who's going to find out about it? And it's sometimes the donors' families of the stakeholders will bring up the issue. And if there's good intent by the board and they want to address it and they want to correct it, generally goes in a good direction. But if the board is not prepared to to address those issues, the problems, then it festers. It just sort of stays there. It continues to get more problematic. The worst case situation, because they are restricted funds. Board members need to understand they're fiduciaries. They have an obligation to comply. Doesn't mean they have to be perfect, and no one is, but they have to do the due diligence to be satisfied that they're doing their very best to be in compliance with the terms of the restrictions. And if not, that's why I mentioned the presentation, they can have exposure to liability. It doesn't come up very often, so I don't want people to be overly concerned. It's just the reality, but you do want to take things seriously, And if you do, and you try hard, you're working with your professionals, you can work things out. It's not the end of the world if there's not being compliance, but don't just sit on the problem. Well, this leads Denzel into a sort of related question. If the board or management think that a charity may not be complying with the terms of an endowment agreement, who should the charity speak to first, their lawyer or their accountant?
Well, their lawyer, in from my perspective, you should talk to your lawyer because from the accounting perspective, we have our rules under ASMPO, our accounting standards, and we can provide general thoughts of what the process from a lawyer's perspective, you're going to take into account the legal implications, which from a board's perspective is by far the most important thing that you're thinking about at this moment. You're not necessarily as concerned, oh no, my financial statements aren't presenting if there's a bigger legal implication in terms of it. And then from that, perhaps your accountant would get involved to kind of help you understand what potentially could be wrong in your financial reporting and in other information there.
Yeah, and thanks, Denzel. And I would agree with that, but I'd also add an additional reason. When you're talking to your legal counsel, it's a protected communication under a solicitor-client privilege, which means neither CRA nor the public guardian trustee or any parties involved with litigation are entitled to that information, strictly confidential. In order to protect that, you want to be careful that you don't waive the privilege by sharing the information you're talking about with your lawyer with someone else. But if the board or senior management goes to legal counsel saying, you know what, I think we may have a problem. Okay, but the lawyer can work it out, and can bring in the accounting team as well, for sure. And sometimes we'll do that by bringing the accountant in as part of the legal advice. So we will retain the accountant to provide accounting advice to give to us in order to give to the client. All of it's protected, right? So work together as a team with your accounting professionals, but do it through your legal counsel to get protection under solicitor-client privilege. Okay, here's another one. Do board members of a charity need to be educated about their obligations with regards to endowments? So start with you, Denzel, first. Your thoughts on that?
Yes, they should be educated. They should know what you have, what your obligations are, what you're supposed to maintain, what you're basically what rules you're supposed to abide by with the contributions that you currently have on hand. Now, does it have to be, an hour worth session going every single detail? Probably not. But what we've seen some organizations do is create somewhat of a chart as to what funds you have, what their purposes are, how much is there, if it's an endowment, what's the use of the income, just to kind of summarize everything, so that the board is aware kind of what is going on from that perspective. And again, from the board's perspective, when they're looking at these sheets, when they're looking at this information, there's a couple things to take into account. Number one, how often has this been, reviewed and updated by management, based on what's going on and what's changed? And the second is that, is there any indication that perhaps some of these things that have been there for years may need someone like yourself, Terry, to come in and review and do more of a deeper dive to ensure what's there is actually accurate. Because at the end of the day, there are some cases we've absolutely seen where, the endowment that was from 30 years ago, you have the terms that have been written on the spreadsheet for years, but when someone comes in and does a bit of digging as to what it relates to, the terms are normally they're not too far off, but they're not exactly what it was stated in that Excel.
Yeah, just to add on to that, I think education of board members is always important. I think it's really important when it comes to that high fiduciary duty. Fiduciary means you put the best interest of the charity ahead of your own. The high fiduciary duty that applies to managing charitable property, particularly property that's held in trust. So it's almost like a quasi trustee requirements. Well, if I'm a new board member and I don't know, about what's happening with certain endowments. I haven't been told how can I, as a board member, do my job? So I think it's really important to do an education process for all board members, but particularly for new board members that are coming on. Here's one. Denzel says, is it possible to have an expendable endowment fund, or is it a contradiction in terms? I think I know the answer to this one from your standpoint, but over to you. Is it possible to
Yeah.
have an expendable endowment fund?
Under ASMPO, endowments indicate permanency and perpetuity. So the idea of having an expendable endowment fund, that's completely contradictory from it. If you have something that is expendable, theoretically, it's probably a restricted fund, not an endowment fund. So it's just, again, if you're doing that as an organization, you're probably doing things okay. It's just not classified in the right category.
Yeah, I would agree. I mean, I think at law, as I mentioned with the definitions that came out of the case law, it's possible to have a fund that's set up to generate income and not have the capital held in perpetuity. It's possible, but it's not the best way to describe an endowment, having that expendable aspect, to it. Although you could have a combination. You could have a gift of $1 million, and 500 of it, 500,000 is going to be expended over a period of time. Then with the other 500,000 to be used as a perpetual endowment fund, you could have a combination. But to call something, as in this question, an expendable endowment fund, I would agree it has sort of a bit of a contradiction in terms there associated with it.
Yeah, and to that point, again, just because you have a contribution with different elements doesn't mean that you can't parse that elements as to this part is an endowment contribution, this part is a restricted contribution. So again, just because it comes as one and it has terms that splits into two different categories, you actually would account for it separately, in terms of it. So think about the nature of it.
Okay, we got some other questions that have come in. Do endowment accounts have to be registered either federally or provincially? Do you want me maybe to start off with this one, Denzel? So an endowment, I mean, it's possible you could set up a separate registered charity as a trust. You could. And if that's the case, then you get charitable status federally for it. But I don't think that's the question here. I think the question is dealing with when a charity receives endowments and has endowment accounts, does it have to be registered either provincially or federally? And the answer is it's a separate restricted charitable purpose trust within the charity. It's the charity that has to be registered. It's not the internally restricted charitable purpose trust. This came up because there was some controversy about changes to the Income Tax Act dealing with reporting on trust T3s, and there was a concern a couple of years ago that this might mean that endowment funds would have to be reported separately. Fortunately, CRA indicated administratively that wasn't required. So the answer to the question is there's no requirement to register an endowment fund federally under the Income Tax Act or provincially, assuming that it's part of the main charity. Denzel?
Yeah, not too much to add on that. I mean, it's a much more particular legal question, but at the end of the day, for accounting purpose, we're really looking at the intention of it, as opposed to necessarily its structure as a trust or not, in terms of that. But completely makes sense that there is the ability to do so, but not necessarily you have to do it.
Okay. My church is the sole beneficiary of a separately registered charity which is an endowment fund. So apropos to what I just mentioned, the
Mhm.
fund never meets its disbursement quota despite reporting considerable income in excess of the disbursement quota each year. How can this be? Don't know, whatever. It's going to have a, but anyway, over to you, Denzel, if you have any thoughts on that.
Yeah, I mean, if the disbursement quota is based on the amount of investments that the amount of assets not in use, not in active use for the charity. So it really the fact that it's making income is kind of irrelevant to kind of that determination, but it would really come down to what income's there. Um, at the end of the day, the only thing I can say is, and Terry, you can attest to it, is that the last few years with the T3010 reporting, CRA has been made it very much more specific to understand what your disbursement quota is and what the calculation is for it. I mean, uh, it'd be interesting to see if they do abide by it, but it really comes down to the portion of their assets not yet in use, and if that is enough to garner the 3.5 or 5% for the disbursement quota. The one thing I would also add is that it's it's less than you would think that you need to get the disbursement quota. A lot of operating or charities come to me and ask about the disbursement quota. Generally speaking, if you're doing any sort of operations, you normally it's not hard to meet that disbursement quota. So it might be a misconception that it needs to give it a lot more.
I think it depends upon the type of charity. So the one that you've talked about, Denzel, where it's got, it's an active charity like a hospital, tons of charitable activities.
Oh
Of
yeah.
course, no problem meeting disbursement quota. But I think in the example here, it was a separate charity that was just an endowment fund.
Mhm.
In that situation, um, because the disbursement quota is calculated on a global basis for the charity as opposed to fund by fund. Here, if the only thing the charity's got is an endowment fund, they're one and the same, right? So if it's not meeting its disbursement quota, which again is 3.5% the first million, 5% above a million of investment assets, there can be serious consequences for the charity. And so, if in this case the church is dependent upon this um, endowment charity getting monies over to it, it may want to have a little chit chat with the endowment charity. Be a good idea to get legal advice and accounting advice in order to ensure that the disbursement quota is being met. Otherwise, you potentially risk losing your charitable status.
Mhm.
Okay.
Terry, I got a question here that I'd like to get your thoughts on in
Yeah.
just a minute. So, if an endowment agreement is silent on maintaining the value of original contribution, i.e., to protect the preservation of capital, is it still required under the law to preserve that capital, or can the charity simply maintain the original contribution as the only amount legally required to be held in perpetuity?
Yeah. So again, to quote you, it depends.
Mhm.
Depends on the wording of the agreement. Um, the agreement might state, the $100,000. That's it. It's to be kept and held and invested, and there's no indication that there is to be maintaining the capital amount to keep up with inflation to preserve it. There may be cross references over to a policy of a charity that might address that issue. Um, but the general approach with case law is that the capital is to be maintained so that it continues to hold its value. And that means you need to keep up with inflation. So good management of endowments should look at having a portion of the income made available for reinvestment. But again, it's not a simple answer because you have to look at the policies the charity has, the terms of the gift agreement that it has, the interpretation of the common law, you need to work with your legal counsel on it. So I'm sorry I can't give it like a definitive answer on it, but generally speaking, you do want to preserve the buying power, the capital power of the capital asset, if at all possible, against the ravages of inflation.
Okay. No, and that's exactly kind of part of the reason is that I do see it all the time, and I do see also as a gray area where, it doesn't say it directly, but it all comes down to the agreement. If there's anything there that indicates otherwise,
Right.
in terms of that.
Okay, we're at 1:30. We said we would end at 1:30. So first of all, Denzel, thank you so much for being part of the webinar today. I learned a lot. Hopefully the folks on the webinar learned as well. And for those that haven't been able to download the slides, they're there. They were in the last link that was sent to you before 1 hour before. If it's not there, we're going to be sending a video replay, and there will be the PowerPoints there for you as well. Please keep in mind that we're running a series of webinars this this winter and spring, and we have another one coming up in the end of March dealing with issues associated with conflicts of interest and remuneration. Ryan Prendergast, one of our partners, is going to be presenting on that. If you go to our website, you can get more information on that. It'll be a very helpful and practical webinar. Thank you so much, everyone, for being with us today. And we hope that you've learned something in the process, and it's been a pleasure to be with you again, Denzel. Thank you.
Have a good one.
Thank you. Bye-bye.